and gold can do anything it wants, right? Gold is one of the only assets in the world where there isn't a one-off thing, meaning, there's a lot of pieces of news that you could give me where I could tell you with a very high degree of certainty what that will mean for the price of oil.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I'm joined as always by the brain trust himself, Mr. Chase Taylor. Two thoughts right out of the gate. First of all, after today and after last Friday, I am decidedly limping. This beatdown on gold in the miners has had a physical manifestation with me. So if anybody sees me with an obvious limp, that's what it's from getting absolutely hammered those last 2 days. It's kind of one of the gifts of significant outperformance is you're going to have retracement days or retracement weeks where it's really painful and it feels like you're giving back a ton of performance. And it's one of the, it sounds weird to say it, but it's just one of the, there's no downside to outperforming, but days like today, if there's a downside, today's one of those days, right? Just because by definition, if you're riding a trend, and even if you're right, and that trend is significantly outperforming the market on give back days, which nothing goes in a straight line, it's going to get you on the flip side and it's going to hurt. And it leads today, like we're down 2.2% and the market's flat. But that such is the game, right?
Yeah, I mean, that's after days of, outperforming. So it's just one of those things. Like, and it's not, we've talked about it on the show. It's not like we didn't see it coming or think it was very, very possible. And thankfully we trimmed everything, and we're still overweight with what the market would be for gold miners, but we still, given where we were at other points during the year and everything, like we brought the exposure down to where it was crushing, just not bone crushing.
Yeah. And to go to your point, that's why and this is exactly what we've been talking about. And we said, if you want to know how painful the drawbacks can be and the pullbacks that are inevitable, look at how high the run up is. And when you run like this, when you're up 130% year to date over 8-9 months, you're going to see 8 and 10% pullback days. It's just, right. It's just, had they been up 25% year to date, today they probably would have been down 1.5 to 2. You know what I mean?
It became a popular trade. Everyone got in it. Everyone loved it. Everyone knew that you had to be in the debasement trade. Like the RSI was like 80 or whatever. Like this is just what happens whenever all those kind of things line up. When everyone thinks it's cool, you have Mohammed El-Arian tweeting about it every day and stuff like it. You just kind of know it's just a matter of time before something like this happens. To me, like seeing this coming, not that hard. The hard part is now that, all right, some of these miners are down 25% already. It's like, all right, can we find our footing soon or do we have a long way to go still? And that's the part where it's easy to see a raging bull market needing a pullback. It's hard to know how big the pullback is going to be. So that,
The other thing, now this is going to sound really bizarre, but I think the other thing that makes this one particularly hard is that, and we were talking about this in our investment meeting this morning. One of the ways that I've typically done this, and one of the ways that I've looked at these things in the past was when you're riding a bull market, whatever it is, you're always going to get pullbacks. And those pullbacks almost always come at moments of intense optimism, right? Where you get investors pricing in too much good stuff, right? And it's kind of easy to see. You see the multiple expansion in the sectors, all that kind of stuff. Stock prices correlating with all that. It's pretty easy to spot. What makes this one so tough is if you tell me that gold is going to pull back 5%, I would look at you and say, I would expect a 20 to 25% pullback in the miners. But in a normal gold bull market, if you saw gold run like this, you'd see the miners valued substantially higher. And this is the part that's tough. They had a good run, but there was not a bunch of optimism priced into those. Which, like I said, I think it makes the overall decision easier by pullbacks. But where that level is, I don't know, because they're still too cheap. You know what I mean? They were too cheap before they took that 25% hit. They hadn't even come close to pricing in where gold is already. So when you've got something that's trading like gold's at like 27, 2,800 bucks, you make an argument they're even trading like it's cheaper than that. You know, it's really hard to want to, you know, like for instance, if this sector was going to have a 50% pullback, it's really hard to decrease size enough to get out of the way of that, because, you know, usually in bull markets, you want to pull back in the frothy times. And yes, they ran a lot, but they weren't frothy. And it sounds weird to say that that's like a problem I've got, but I think that problem, when you watch something go from too overhyped and too hot, right? I feel like it's kind of, you know, let's say Costco goes sideways for the next 10 years and starts trading it, or next 2 years, and all of a sudden you can buy it at a 30 to 32 handle, right? It's pretty expensive for Costco, but still, like, you know that's much more of a sustainable price level than buying Costco at 50 times earnings, right? When you flip around and look at these things were dirt cheap 4 days ago. Especially in relationship to the price of gold. And they haven't gone up anywhere nearly as much as you would think they would have based on how far the price of gold ran. My whole point is that the undervaluedness and the undervalued nature of that sector is making even managing the pullbacks hard, because, you know, it's like, well, but buy when they get down to really cheap fundamental value. And you're like, well, they're there.
Yeah. So that's where I think there's two ways of looking at it. Obviously the fundamental way, the most important way over time, but to view it for like a shorter term and technical trading perspective, where this is kind of the cool thing about this, is like fundamentally you haven't even almost reached fair value, but on a trading basis you're 60 days above the 200-week moving average, 60% above the 200-week moving average. The RSI was, you know, on a different planet. So like you can see on those short-term trading metrics, hey, like caution ahead, which kind of lets you bring positioning down. And then if those things go back to normal, or, you know, even more preferably, if you get lucky, to oversold, where you get that RSI goes from like 80 to back to 40 or 30 or whatever, then you could just back up the truck, knowing that the valuation side, you know, was never expensive. You can be overbought and cheap, and you can be oversold and expensive. And this is just a perfect example of you were really overbought, but cheap. And that's,
yeah, I think that's a great way to put it. And I think that, I think that's also reflective too of kind of the changing nature of this market and how it's decidedly different. And I think so much of that, so much of those moves are just representative of, you know, belligerent retail pouring money into things in late stages of their runs. And I mean, you and I were talking about that. You know, we've been talking about it for the last really month and a half, just saying, yeah, hey, we love what's going on in gold, but when I'm seeing it go up this incessantly day after day after day, it just reeks of that retail mentality, you know?
Right. And people are lining up at physical gold shops to go buy it, you know, like that tells you too, like,
yeah,
right, like near-term top is coming.
Yep.
And the volatility is something that's notable. Like if you look at gold, like if you back out, like you have tiny little candles, and then all of a sudden in the last 3 or 4, 10 days, it's just giant range of trading. Like the 10-day vol on GLD is 50, almost 51. It's normally 20. So like you just started having giant moves that kind of let you know, like, hey, might be a short-term top here.
Yep. And we had some of those days, and, you know, for people listening, they're probably like, what, Zach, why are you saying it hurts? You guys were saying you're going to get a pullback. It always does. I mean, even if you trim, even if you do it properly, just I mean, nobody likes to see your account down 2.2% on a day where the
Right.
market's flat. I mean, it's just miserable, you know.
Pat
But
said it perfect today. Even if you have a 1% position, it's not fun on a day like today.
right, and that's a very true way to say it. And everything's just getting lit up, and
But
that's
gold's where it was last Monday. Like for perspective, let's see, GDX a little worse. It's where it was September 24th. Like grand scheme, not a huge deal.
not a huge deal at all.
And whenever you have massive outperformance, you just know like the Reaper's coming to take some of it back. It's like a rake at the casino. It's going to get some.
Yep. And what I have found is that how you manage those pullbacks is the most important. It's the most important aspect in terms of how much you end up making on the trade, because those pullbacks, especially when you're long in them, they feel like they're never going to end, and they feel like the run is truly over. And I think that's where you've got to keep falling back on the fundamentals. And then also trade discipline. The other thing that you've got to keep in mind, especially with gold and gold miners, and this is a really important lesson. Nothing like they are forever linked to gold, and gold can do anything it wants, right? Gold is one of the only assets in the world where there isn't a one-off thing, meaning, there's a lot of pieces of news that you could give me where I could tell you with a very high degree of certainty what that will mean for the price of oil, right? There are very few, if any, pieces of data that you can give me that will tell me what. Now, I can tell you what it will probably do to gold over the long run, but immediately, right, there's no piece of news that gets released that tells you, oh, gold has to go up, right?
Yeah, I think central bank buying is about the closest we have these days. But and that's really the only last 3 years that we've had that. So.
Yeah, and I think that trend is going to be with us for a long time. And the reason I think that trend is going to be with us for a long time is whether central banks like it or not, their dollar denominated exposure is growing daily, right? With dollar denominated debt growing daily, and that's going to have, again, like we've said, nothing's changed. The only way they're going to hedge that exposure is gold on their balance sheet. And so I expect that pressure to come in. But like you said, I think looking at things like the RSI, looking at more technical things that would usually fall on, more your side of the table than mine. I think those have to be indicated in here because especially with this overbought but cheap dynamic, you're not going to get those fundamental price signals where you go, okay, right, if I buy it here, I know I'm money good, right? You don't know that because it's not like oil. Gold can trade anywhere. Oil obviously can too, but if oil gets drilled and it's down trading between 30 and 40 with a very high level of certainty, I know that if I buy anything oil related, I'm probably going to have a good 3 to 5 year return on that asset.
You know it's going to hit production. Yeah.
Right. Gold doesn't work that way. Right. It's a completely different animal. And so that's what's going to make managing these pullbacks really, really hard. And I think we're going to have to do it. I think the only way you're going to be able to successfully manage those is by watching that. And at least until this price and value fundamental flip, just because, like I said, if you're looking for a fundamental entry point right now, looks unbelievably good. But, you could be walking right in front of a 30% clip too. Now with the sell-off we've got today, I would be surprised if you sell off another 20% from here, just because, like you said, you've already got some down 25% from their highs. If these things leak another 25%, I'll be in there buying. Because at that level, they're just so cheap, even at $2,500 gold.
My big line, my like kind of giant like better get in there line is about 23% away from where we are now, and it's like a basically a 1/3 drop from the high, and that's like, it's an area where you had consolidated a little bit in the past and even earlier this year, and same with just the actual gold price. If you remember, like all spring and summer we went sideways. You remember that?
Yep.
And then we just blasted out of that range. So to me, the hope would be, if you want to back up the truck to gold, would be like you retest the top of that range at around 3,500. That's the area where like I just feel great about getting in there. Doesn't mean it works, doesn't mean you'll ever get there, and may never, but just as a way to just make it simple for myself, like that's the kind of things I want to do, is buy the top of the old consolidation kind of thing.
Yep, I think that makes.
You said something that brought something to mind. I want to mention. Talking about dollar denominated debt. But first of all, gold is actually about to pass the dollar on central bank balance sheets, on reserves, I should say, central bank reserve assets, which is interesting. Like, so for, I mean, I don't know, all my life, maybe most of it, at least, you've had other countries holding a lot more dollars than gold. And now all of a sudden we're about to be, probably next year, they'll be holding more gold than dollars. So they are making this move quickly. But the other thing I wanted to mention is a new trend that has started small and quietly. So I shouldn't say no one, people aren't talking about it much, especially in big circles, but China has now done a deal with both Kenya and Ethiopia to convert their dollar loans into yuan loans. And I think they're going to keep doing that at scale over time. Now it'll start in Africa, but you may get in a situation where you have other countries in Asia and I mean, maybe even Eastern Europe and stuff someday where they're like, oh, you haven't promised those dollar loans? Yeah, we'll take care of that for you. Here's your new yuan loan, and we'll give you some nice terms on it.
What's their incentive?
So if you're the country, the just FX side of it means it's a cheaper loan for you, or the rate side. Our rates are a lot higher than they are in China, so it's better financing. And obviously for China, you get the soft power aspect. You get the
bid under your currency,
owing you instead, in a way. Yeah. And it helps you keep the currency up without you having to do all the work. So it's good for trade financing for them in the future and stuff like that. I'm sure for infrastructure financing these people, like, so it's just interesting to see that kind of start, because that's been one of the, if you think about Brent Johnson's milkshake theory, maybe the thing that underpins it is all the dollar debt that's out there, and that if the supply of dollars gets low enough, that debt, how do you repay it? Well, if enough people refi into yuan or euro or something, like, well, that is a way, that's an off ramp that is difficult to, figure out how it will play out. But we have started that process, at least in two, smaller economies globally.
Yeah.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
Now, flipping to the broader market, generally speaking here, I was on, or I did several interviews last week, but one of the things I was talking about was that, I had the full caveats in there and all the grains of salt needed, but just said, look, as much as you hate to make short-term market moves, based on what I'm seeing in vol markets, specifically vol and equities, had me really concerned. We talked about it, and I said, I think you're setting up for a big move one way or the other. I think it's probably going to be to the downside, not the big downside, but I was expecting a 10 to 15% hit. Mm-hmm. Based on what we've seen the last couple of days, I got to flip around and say, now, again, technically looking at the board, it actually looks like right now, I think you'd have to favor breaking out to the top. What are you seeing there?
Yeah. And hey, we could just do nothing for the rest of the year, go sideways. But you're right. Like my big concern really for the last 3 months has been the systematic positioning was just wildly too long. And the crazy thing is we burned a lot of that off with a 3% drawdown. So that makes me a lot less worried about the downside from the mechanical standpoint. Now, if you get fundamental reasons to go down or more bad news on trade or whatever, like, yeah, of course, all bets are off. But for now, your positive gamma, vol control puked about a third of their book. So like you're probably fine to just go up or stay. But I don't think we're going to rip higher. I think it would be small stair steps higher from here. And if you go back and look at VIX, I mean, spot VIX went from 29 almost to 17, like that. So yeah, as fast as it worried us, it just as quickly said, never mind, gotcha. And the annoying thing was, like, while we were focused on that, gold vol was going up over here, and we should have, like, that was the one that we, at the end of the day, should have been a little more worried about, but it actually actualized its fall, and the market was like, yeah, see it, we're going up. And the crazy thing is, like, we've had some bad news, like Trump came out today. I was like, maybe I'm not going to meet with Xi, and maybe we still will do that 100% tariff, he said, I think yesterday. So it's like, okay, like the market only cares about the bad news on that, or the good news on that.
Yeah, that's kind of, and some of these dynamics have been playing out for a while, so it doesn't really sound like news, but that's, to me, that's just kind of this whole retail involvement in this market, meaning I see all kinds of extraordinarily bullish, fired up investors. I just have no idea why. You know what I mean? Like I'm looking at this market backdrop and looking at valuations and going, and not in a way where, like, I'll look back 3 months from now and go, boy, I was really missing this. I don't think that's going to be the case at all. This is not an environment where you want to be bullish. It just isn't. Now, they could end up being right over the short term and we could take off from here, but there's no inside market knowledge or something they've cracked that's kind of given them the clue here. This market has always struggled when you've gotten up to these level of valuations. This level of valuations has been kind of a roof on this market for a very long time. Go ahead.
The only thing I can say for the market is that earnings expectations have really recovered, and as far as, like, the way companies are talking about that a quarter or 2, 3, 4 out, like, has really improved. If you remember back when we got to the point where the market was forecasting 7% earnings growth for the year for 2025, and I was like, all right, that's too low. Like, that's going to come up. Well, now we're getting close to being back at 10, and we started the year, at 12, 13. So from 13 to 7 back to 10. But now I'm starting to feel like, all right, if we get above 10, now you've done the opposite. You're getting too excited and you're pricing in too much. Things like tariffs are gonna eventually weigh on growth. Like, I think a very underrated aspect of the backdrop right now is actually oil. Like, energy prices being so, and gas, energy prices being so cheap they've done more for the economy, I think, than we all realize. And if at some point in 2026 that stuff picks up, I think it will do more damage to the economy than we realize.
Yeah, it's really interesting. And obviously you'll never know, and we would never know, but it would be really interesting to see if you didn't have these oil prices, these energy prices where they are, if they were significantly higher, and you didn't have the CapEx spending that's going on for AI right now. My guess is you'd be at zero growth to slightly recessionary environment. That's my guess.
You would at least be in low growth for sure.
Yeah, that's even when they get these quote unquote good news out about consumer spending, the increases in consumer spending to me look a lot like inflation.
I agree.
You know what I mean?
It's not bad, but like it. Yeah, and I still think. I mean, the big thing is obviously, as we always talk about, is we've talked about the K-shaped stuff a million times, and that's really it just gets more pronounced every day. Where the well-off people are just that much better off because their stocks go up, and the people not well off are just that much worse off because inflation is very real and everything but energy, healthcare, insurance, like food, like obviously goods because of tariffs. Like inflation is still pretty brutal in all those areas. I mean, even measured inflation right now is 3%. With oil at $50 and gas under $3 a gallon nationally, you still have 3% plus inflation. Like that tells you a lot. Like what would inflation be if gas was $5, $6 or something? Like we're taking a lot for granted in that space. And healthcare costs are, depending on the state you're in, you're 10, 15, 20, 25% year over year for health insurance. Like, and that stuff just gets worse next year. So that squeezes people. Like that's real life impact on how much stuff people can buy. So there are plenty of reasons to still be cautious in the economy. But like you say, you build enough data centers, and that's very real spending in the economy that sucks up a lot of capacity and makes growth look, flatters growth. That they have to pass that baton to other forms of capex. I think that's gonna be one of the big stories in 2026. Is like, does capex outside of big tech pick up, like industrial manufacturing kind of capex? And if yes, then I think we'll be okay. You can avoid a recession next year. But if the answer is no there, and you get any sort of slowing down in the rate of growth, not like top line, but like the rate of growth, the second derivative of all this tech spending, then even that would be a bad thing.
Yeah, no, I don't disagree with any of that, man. It's a complicated market, and it's going to continue to get more and more complicated. I think one of the toughest things still to manage intellectually in this market is the disparity in valuations and prices. Just because if you're going to keep going up, it's not hard to know which stocks need to participate. But I would say this: it does feel to me, we've been saying this for a while now, but I think if this market moves substantially higher, my belief is the place you want to be is probably a lot of the things that a week and a half ago you were looking at that made us think that possibly the market was going to resolve lower. Meaning, you probably want to own the stuff that was below its 50-day moving average within the last week. You know what I mean? Because I do think that you're so stretched at the top of the indexes. If this market's going to move higher, I think it's got to get help from the bottom half.
Yeah, and you saw that today. Equal weight was up 0.5% with the S&P flat. So like,
there you go.
One day. It's just one day, so who knows? But you saw it today. I mean, Mag 7 is down 0.2, so got beat by 0.7 from equal weight. It never seems to last, but this is way bigger theme. That's what we're talking about short term, but a way bigger theme for me is like, if you look at capital inflows, which we talked about a lot early in the year, not as much lately, they've really come down lately. So the last quarter or two have slowed a lot from the first half of the year, slowed a lot from last year, slowed down, So if you ever get to the point where the capital flow is literally reversed to negative and they leave, capital is actually leaving the US, and I'm not saying that's going to happen this year, next year, but when we get to that moment, it's going to be massive. Our indices will have major problems. So when you enter that's when I think you want to be in the stuff no one's cared about, like, because do like the Swedish pension fund or whatever, like, do they have to sell down their like oil services stocks? No, they don't own them, right? They have to sell their big tech because they have it in size. So like, being in these like real assets and real asset adjacent equities, to me, it has been a pain trade for 30 years or whatever, because all the flows miss them. But when outflows are missing you, but inflation's driving up your revenues, man, it becomes this an awkward safe haven after commodities have been anything but. It won't last forever, but it'll have its moment
for a long time. And I think that process, I think that what you just laid out is kind of in process right now. And I think that for a while, it will take a while for the market to start acknowledging that they're going to trade. And I thought you said it perfectly. If you want to know why every time you get a sell off in these commodities that it's so nasty and violent, look at the last 15 to 20 years. That's been the way, right? The commodities were only good to ride short-term runs, and then you got out and they fell back down, right? It will take a while for the market to learn that's not the case, right? Yeah. It'll take a while for the market to make that adjustment, and then you see it in every cycle, though, right? You get to that point. It's hard for people to remember this, but this is exactly how tech traded from like 2002 to 2010. You could catch little rallies in it, but whenever you did, you sold them. It was just they went nowhere.
Yep.
And it's so crazy to say that now because it's the inverse. And back then, everybody, you were making the money in the materials, the banks, the financials, literally the opposite stuff that is working now. And this too shall pass. And I think that I do believe that process has begun playing out. And this is totally anecdotal, but something I think is interesting that hasn't got enough press. And I think this is going to be one of the bids underneath commodities going forward. It's just a more competitive world. Meaning we're in the middle of this AI boom, right? And in the last 2 weeks, trade tensions with us and China have picked up. right? I think it's really interesting to know that they didn't pick up because of microchip or chips, right? They didn't pick up due to semis. They didn't pick up due to some new AI technology. What was it about? It was about rock. It was about raw materials, right? Raw earth metal, rare earth metals, natural resources. And in a world of infinite money printing, especially when that money printing is no longer curtailed in any way, meaning, if you just think back 15 years ago, central bankers were much less flagrant and much more cautious about the vernacular they used, the words they used. You'd never hear them say things like print money. You know what I mean? Like it was more taboo, right? Like there was
Yeah.
still concern about that. Now it's not, right? It's not a taboo thing anymore. And in a world of infinite capital, you're going to see real assets and scarcity get bid. You just are. Um, and in a world like that, that's one of the reasons. And you can't find anybody in the middle. I think you and I are about as close to the middle as you can get on this topic. But that's one of the reasons you can't turn your nose up at something like Bitcoin. Not completely, because it is the scarcity of nothing, which is one of the reasons that we don't own a bunch of it, and is one of the reasons we don't hodl it like everybody else, and we trade it and protect the downside. That being said, I can see there being a long-term argument for Bitcoin being that digital gold, and in a fiat world, just being that receptacle that catches extra printed money and liquidity and all those things. And um, it's and I think you have to stay open to ideas like that. And I'm not trying to pump Bitcoin or anything else. I think most people listening know our thoughts on that. I think you and I think pretty similarly on it. Um, but technology always changes the way that we manage things as human beings, right? Like, um, you know, go look at responses of corporations to a slowdown in the economy or revenue, right? The way they're going to respond to that is different today than it would have been 50 years ago. And most of that difference is going to be made up in, technological differences and technological advances today that allow us to do things at a different, you know what I mean? Technology is constantly going to change the way. And if you think about it, that's the chief role of technology, right? It's a buffer between human beings and the environment around us, and it helps us navigate it better and all that kind of stuff. My point in bringing that up is, and I think history proves this, is it to look at an inflationary cycle or a deflationary cycle, and to look at the way assets performed during those cycles and to assume that they will do that again is really foolhardy to me, because different assets have different roles in economies at different times, right? Different things will inflate. And actually, I think if you look at the history of inflation, I think that's what it tells you, which is prices will go up. It is very dynamic in terms of what will go up the most, what won't, different things that are impacted, because there's so many other, pushes and pulls and other things you have to consider. But in that vein, when you look at something like Bitcoin, I think you have to keep an open mind, because um, is I will always be suspicious of an asset like that has no intrinsic value. But I mean, let's turn around and look at a lot of currencies around the world today. I think you could probably make a similar argument for them.
Yeah, I mean, it's more scarce than every other currency. It's more scarce than even most commodities. Even if it is scarcity of nothing, millions of people think it's a scarcity of something important. So the network effect of that means it's probably going to be fine. Probably going to keep going up. It was notable to me how well it did today, given the gold backdrop. After it finally had started to look like, now wait a second, is it just going to completely stop keeping up with gold for a while? And as soon as I think people started to give up on it, then you have gold get smacked by the worst in 12 years or whatever intraday, and I'll look over at Bitcoin and it's like fine, and I was like, okay.
Yeah, well, no, I noticed that too, but the inverse of that had happened over the last 2 weeks too. You saw days where
that's what I'm saying. Like it had just started to look like gold was just going to blast off versus Bitcoin, and then all of a sudden, and then in one day it's like, oh well, maybe not.
Hey, it's so funny. I mean, you and I have experienced this a million times, but it is so funny. This goes right back to the outperformance talk, right? Which is, outperforming is awesome. Love to do it. But anytime you've got to simultaneously know these days are coming. It is funny to me how markets work, because when those days are working in your favor, you feel like a flippin' genius. Even though you know this is going to turn, we're going to have days where this trade is working on me in the opposite way. We're going to have it where I am walking around limping, but it's just, you're never as good or as bad as you think, you know. Um,
100%. Yeah.
and like I said, when you start feeling it, you look around, start looking over your shoulder, and that's what we've been doing for the last 2-3 weeks, right? I mean, I think you and I were saying that, just hey, we need, and we prepared for it. We were ready for it. That doesn't mean it still doesn't sting. It still does. It's not fun at all.
No, it
No.
never is. Yep.
What else do you notice? Anything else catch your eye today?
Uh, Let me think. Not that I can think of off the top of my head. We talked about a little bit in our meeting this morning. I'm just, it's no surprise to anyone listening, I'm sure, but I'm pretty excited about where I think nat gas can go, both short and kind of medium term. And I was going to talk about the show yesterday, but we couldn't do it because AWS decided to die for a day. But aluminum is a market that we're starting to watch really closely and has started to invest in. I'm excited about that one in a big way. That's been a market not worth investing in my entire investing career, and all of a sudden it is. So that's always fun.
One of the best moves I made on early in my investing career, I think it was like just after the bottom in '09, and some older guys were walking around the office mesmerized and laughing about how cheap you could buy Alcoa. Well, guess what? 3 or 4 years later, you could buy it even cheaper. And it's just funny you bring that up, because I don't think aluminum has moved my entire career.
It's been stuck in a pretty tight range for many, many years. And production, until recently, production just always went up, and China basically took it all over like they did most things. But this is like an interesting story where, we have this anti-involution thing from China where they're trying to like keep people from over competing. So it must be a nice problem to have. But they put a cap on aluminum production 8 years ago, and it's just now starting to matter. But now all of a sudden it matters a lot, because we actually need more production. We're not getting it, because and the beauty of this trade, I think, is that at the end of the day, what it comes down to is energy prices. And I think energy prices, for like things like gas, like electricity, like more than just broad energy, but electricity prices aren't going lower from here. And at the end of the day, aluminum is just a derivative of energy, because bauxite mining is pretty easy, but it takes an insane amount of electricity to actually create the aluminum. So it's just really a play on energy prices at the end, and then clearly supply and demand. And demand's exploding, supply can't keep up, it's too expensive.
Is there a new source of demand that's come online? That's
EVs is the big one.
Okay.
But really, same with solar power. All those, like all the frames and wiring for all the solar stuff. And then the most interesting to me, and I talked about on our meeting today, but is reconductoring. You take the power lines and you basically redo them. And you can add tremendous new capacity on those. Like a lot of our power lines are like overloaded, and you literally see it when they sag sometimes. You reconductor them, and it takes a lot of aluminum, and you can push way more electricity through the same power lines. Obviously, way cheaper and easier, and less permitting and red tape and all that kind of stuff than building a new power line. A lot of people are like, we need to build new power lines. Like, no, you need to reconduct the ones we have first. But if we do that at scale, you're talking tremendous demand for aluminum that would show up. So there's a lot of new demand sources, but the EVs are the important one, because you can't use recycled aluminum for that the way you can most things, because aluminum is very easy to recycle. Most of it does get recycled. That kind of holds the price down. But because EVs, they need like very specific alloys and stuff, it's usually new production. So that is kind of one of the big demand catalysts at the moment.
okay. Okay, that's interesting. I think that there's going to be a lot of action in those parts of the market, and I think that if I think it's going to take a lot of investors a lot of readjusting, or plain just getting used to it, because where so many of these big winners have come out of the technology space for so many years now. I think it's going to be wild for people to see that, but you get into one of these commodity super cycles, and I think that we've started one. That's my belief. Um, you're going to see you're going to start seeing that kind of action in those kinds of names, because like you said, nothing moves for a long enough time, and that sort of becomes its own catalyst. And I think the aluminum story is a perfect one, right? You just waited for a time to come along where something would pop up that would require a bunch more aluminum that you couldn't get out of recycling. Right? Inevitably, it always ends up happening. It's almost impossible to predict the timelines on these things, but it does. And you see it broadly across the entire commodity space. Just the underlying stories behind so many of these different commodities and metals is just different than it was 10 years ago. You don't have this chronic oversupplied situation that you did so many years ago.
Exactly.
And, for people that, it's one of the reasons that I'm still bullish gold and the gold miners. Unlike past cycles of gold going up, you don't have a bunch of production that's about ready to hit the market to respond to these higher prices. There haven't been no new net mine openings for a decade, or more. I think it's actually 12 years. So, and that really broadly has occurred across the entire economy. There is no commodity that's boomed, other than maybe like lithium in the last 10 years. And that was just a very specific EV type situation, right?
Yeah, and that already crashed. So
Right. There's no froth in that anymore. Speaking of which, I haven't looked at lithium for a really long time, because every time I looked at it, it was so wildly overvalued because of the EV story. It just never made sense to me. How do those things look? I mean, I know lithium, a lot of that froth has been pulled out of those names, but
yeah, I mean, lithium got up to like $85 dollars, and now it's at $9.60. So yeah, I mean,
that was one of the other things I never understood about that, because there is so much lithium out there and it is so easy to get to.
Yeah, it has bottomed. It basically bottomed around August at like $8. So from 8 to 960, you're picking up the miners in the space have picked up, like it's starting to do better. Speaking of an interesting side nugget on aluminum is there's some battery chemistries that use aluminum instead of lithium that dramatically outperform lithium batteries on, all the important metrics, like how long it holds charge, how long it takes to charge, all that kind of stuff. And they're, but it's like, it's so early stage. You cannot model it in as like, oh, this is going to work. This would definitely get commercialized and work. But like the early returns on the science experiment is the stuff's great. So, and I think that's one of lithium's problems is you never know if some other new battery chemistry comes along and just smashes it. But, at $10 lithium, or even $20 lithium, like, all these battery producers get to make a lot of money probably. So that's probably one of the reasons that, grid storage batteries and everything's just exploded. Every tool at Home Depot has a lithium battery in it now. So like the funny thing about things getting cheap is, it makes them more pervasive. So.
Yep. Definitely more ubiquitous. Anything else you got to add to that, man?
Nope. That's it for me.
All right, brother. Well, hey, yeah, it's the one thing this market has been very good at, especially lately, is confusing me. I feel very lost right now in terms of where I think this. I see it looks like you got a breakout going on, but I wouldn't be at all surprised a week from now if we were back on thinking that you were going to get hit. So
you're one bad headline away from being worried again.
Yep. Until then, all righty. Well, that'll do it for us today. Thank you guys very much for listening. We'll be back again tomorrow, AWS permitting. That was pretty wild, right? The way the bind that AWS can put the world in.
It turns out we're all slaves to the AWS. We didn't know it.
Yeah, I know everybody talks about too big to fail, and I was kind of like, boy, maybe we start taking a look at some of those things. Anyway, all right, so we'll see you guys tomorrow. As always, find us on social media, Twitter, YouTube. Just search Know Your Risk Podcast, and we're easy to find. We'll see you. Hey, have a wonderful evening. We'll be back in tomorrow. Know Your Risk Podcast. Go Know Your Risk. Download and subscribe at knowyourriskpodcast.com. Thanks a lot. Bye-bye.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.